Hi, this is David Dickens, and today we are doing part 2 of our two-part series of 2024 stocking stuffers for your financial freedom. Just to kind of wrap up the year. So last time we did 4 stocking stuffers, kind of quick hit ideas that you can wrap up the year with. This time we got another 4, plus a little bonus 5th one. So hopefully 1, 2, 3, or maybe all 5 of these are of interest to you. I hope it's a fun episode. I'll get Walter, and we'll get started.
Do you need help protecting your finances as you enter retirement? David Dickens of KC Financial Advisors has got you covered. Welcome to the Cover Your Assets KC podcast.
Hey, thanks for joining us for another episode of Cover Your Assets KC, last show of 2024. We continue that conversation on discovering some financial freedom, your best stocking stuffers that'll unlock that freedom into next year and beyond. Looking forward to part 2 of the conversation today. David, are you all set for the holidays? We're only a few days away from Christmas now, and the new year will be here before you know it.
Unbelievably, and very unlike me, I am totally ready for the holidays.
Usually a little more stressed at this point of the year, so that's a nice change. Huh?
Yeah, but usually there's a lot left to do at this point, but I'm feeling, pretty good about where I'm set. What about you?
Doing about the same. Yeah, ready to go, ready to turn that page to at the end of the week. I think things will be like, all right, we're off the gas pedal. So I will be very much feeling the same. We're all done with our shopping, which was nice. I had to go to Target on Saturday last weekend. So, a week and a half out from Christmas, I was like, oh, this is going to be a nightmare.
Yeah, you and about 1,000 of your best friends.
Really didn't want to go, but we needed to buy, we did one of those like Angel Tree, Adopt a Family things. Yeah, and so we just waited too long that we couldn't order everything on Amazon, so we had to go get it in person. And we joined the masses. But tell you what, it wasn't bad. We actually got through the checkout line in like 5 minutes. I thought we were going to be there for an hour or more, and it was not too bad. So I was surprised by that.
Very nice.
We'll take it, right? We'll take the wins.
Yeah, it must have been a time of day thing. You probably got there at 6 a.m.
No, we were like middle of the day, so I don't know what we did right that day to catch it at the right time, but it wasn't too bad. So good luck over the next few days, though, getting in quickly.
Exactly.
All the other last-minute folks. All right, well, I've got your list here, David, so let's hop in here. So again, we're giving you ideas, action items, things to focus on here at the end of the year and as we turn the page to the new year to keep in mind and filling your stocking up with these ideas. So the next one on our list, David, after last week's conversation, is to don't overlook debt. Got to make sure we're keeping that in check.
Yeah, and a lot of our listeners are going to say, this is so obvious. Why would you even bring that up? But it is amazing the number of times when I talk to even existing clients who have plenty of money, but maybe visiting with a prospect or even at a party with somebody, and it comes up, your financial advisor. It's amazing what people will say to you when they find out you're a financial advisor. But the number of people that carry credit card debt is really shocking to me. And we've talked about it a number of times on these podcasts, but if you've got credit card debt, you just need to get serious about getting rid of that ASAP and never having it again. You are the bank's best friend if you are having credit card debt. The fees and the interest are just crazy. So a couple of months ago, I believe I went through one of these, but I know people who contribute to their 401k and they have credit card debt. And so if you happen to be in this situation or you talk to somebody over the holidays, a younger family member of yours that is in the same situation, here's what I would suggest that they do. Contribute to the 401k and get the match that their company offers. But above that, take all of that money and get rid of that credit card debt, whether it's paying it down over a month or 3 or 6 or depending on how much you've got, 8 or 12 months, but get rid of that credit card debt after getting the match in your 401k. Don't spend your hard-earned dollars trying to save up for retirement that's 20 or 30 or 40 years off while you're paying these interest and fees on your credit card. So, number one, pretty simple, super obvious, amazing how many people aren't aware of the obvious. So that's why I bring it up here. It's an easy little stocking stuffer to stuff your own stocking for 2024, 25, and beyond.
We always have to do that check, right? Because you certainly live in this financial planning world every single day of your life, and even I am, living in it pretty much every single day, getting to talk to you and other, folks across the country that do finances, and we're pretty plugged in. And sometimes we take those basics, those foundational things for granted. So it's always good to bring those up because someone who's not kind of dancing in this world might lose sight of it and forget every once in a while. So I like that. All right, how about this next one? Consider Roth conversions to reduce future taxes.
Yeah, so I talk a lot about this to my clients, a lot of whom have yet to start required distributions, so they're not 73 yet, but they're retired or soon to be, and we're starting to talk about, well, how do you manage taxes in the future? So the easy way to figure this out, if a Roth conversion could be important to you, the only real deciding factor is, if you did a Roth conversion now and paid the taxes, would you pay your taxes at a lower rate than you're going to pay when you're 73, 74, 75? And you're currently looking at your phone, your app, saying, well, Dave, I don't know what tax rates are going to be then. That's true, but there's a really good chance they're not going to be lower than they are today. And they may extend the Trump tax cuts, they might not. But here's what you want to do. Do a quick little calculation that you can estimate the amount of your required minimum distributions when you're 73. So I won't unpack that today, but there's a past episode that will. But you're just trying to figure out, well, what's my IRA going to be worth at 73? All my IRAs and all my 401ks, what's that going to be worth at age 73? And then apply a factor. Right now, it's about 3.77% in the year you turn 73. You're going to add that dollar amount that you're going to be required to take out, plus Social Security, plus, if you have one, your spouse's Social Security, plus any pensions that you get, plus your interest, plus your dividends. What tax bracket does that put you in? So, for instance, if you're married filing jointly right now, if all of that stuff adds up to over $94,300, then every extra dollar you get is in the 22% bracket. So what you may look at then is, well, my income this year, since I'm newly retired, is only 50 grand. And that is in the 12% bracket. So the difference between 50 grand and 94 grand, that $44,000, is money that you might want to think about taking out of your IRA, paying the taxes now at 12%, and rolling it into your Roth IRA. And as every listener to this podcast knows, once you have money in a Roth, the money you put in has already paid the tax. You don't pay any tax on the growth, and you don't pay any tax when you take it out. And at age 73, 76, 92, there is no required minimum distribution in a Roth. So there's some really good reasons to chip away at Roth conversions before you get to be 73. And I would encourage you to take a hard look at that. If you do one for 2024, well, you've got 2 weeks to figure it out. But maybe you say, I'm going to figure it out over the next 2 weeks and do one in 2025 and 26 and 27. Do yourself a favor and at least go through the exercise and figure out, am I and my family going to be better off if I do some Roth conversions over the next couple of years? So please take that seriously, make that calculation, and see if it's good for you.
It's fantastic. If you have questions for David Dickens, I can tell you an easy way to get in touch with him, by the way. All you have to do is call 913-317-1414 if you need help figuring out the right way to do those Roth conversions or just other strategies to reduce future taxes. That's a big part of the planning process, and so you can have that conversation very easily, again, by calling that number or go online to coveryourassets.kc.com. Coveryourassets.kc.com. David's based in Overland Park, as you might know, but serves clients all over the place. So don't hesitate to reach out if you've got any questions on those kinds of matters. And we've got that contact info in the description of today's show as well. All right, David, next on our item here is we're filling up our stocking stuffers. They're getting pretty heavy. They're starting to drift down toward the floor at this point after the first episode being combined with this one. So that's good to see. You always like it when you come down Christmas morning and see that stocking just, maybe laying on the floor at that point or
just
starting
bulging.
to touch the floor.
Yep.
Older you are, the more stretched out it gets, which is nice. So our next one here is very appropriate for this time of year, and that's to use a qualified charitable distribution, or look into QCDs, as they're often known in the short form, for giving purposes.
Yeah, so this is only for listeners that are over 70 and a half, because that used to be the required distribution age, but they haven't changed the QCD age. So even if you're not taking required distributions, but you have a big, fat, juicy IRA, and you're also a giver, well, a way to give by taking money out of your IRA, but not have that money be taxable, is through a qualified charitable distribution, or a QCD. So here's how it works. If you're over 70 and a half, you can take out up to $105,000 out of your IRA. And if your spouse has one, he or she can take another $105,000 out. Next year, that goes up to $108,000. So it's somewhat geared to CPI or inflation. Now, and then you gift that money directly from the custodian, Fidelity, Schwab, whoever your custodian is, directly to the charity. If it gets into your hands and you write a check, then it's not a qualified charitable distribution. Here's one thing that I get a question on a lot. You cannot do this from an employer plan, a 401k. You can only do a QCD from an IRA, which is another good reason, once you retire, to roll your 401k out and put it into an IRA. A lot of good reasons to do that, but this is one of them. And here's kind of an unusual one. You can do a QCD from an inherited IRA. So you're over 70 and a half. You inherited an IRA from your brother or from your whoever, an uncle, and you're like, oh, I have to take this required distribution out of it, but I don't want to pay the tax on it. Well, you can do a QCD. It doesn't have to be your IRA. It can be an inherited IRA. So real quick example of this. Let's say that you've got a $600,000 IRA. Your required distribution is going to be about $25,000. And in March, you took a distribution because your church had a building campaign and you wanted to throw a chunk at your commitment. And then October rolls around and you're like, oh, I have more required distribution to make. I want to do a QCD. And I'm going to send some to my university, some to Salvation Army, some to City Union Missions, and I want to do the $25,000. The oops is you already did the $10,000 earlier in the year. You had the custodian send a check to your house, and you wrote a check to the church for the building campaign. You cannot reverse that and say, oh, wait a minute, I meant that to be a QCD. I want a little do-over here. There's no do-over. So you can either do a $15,000 plus the 10 you did earlier. That gets you up to the $25,000 required distribution that you have to take. Or there's nothing to say you couldn't just do another $25,000, and that would, of course, be a QCD, but you'd still have the $10,000 that you mistakenly took out in March, had the money sent to you, and you write the check. So the only magic that works here with a QCD is you can't have the money land in your checking account and you write a check. It has to go directly from the custodian to the charity of your choice. Other than that, it's a fantastic way. If you're a giver and you don't need your required distributions, or you don't need some of them, it's a fantastic way to not pay taxes on money that is otherwise definitely going to come out of your IRA.
Great breakdowns, and I know that the Roth conversation which it's interesting that Roth always has a C behind it, whether we're talking about conversation, contributions, and conversions. they all point back to the Roth today. So a little bit of a sneak preview for you for a little bonus item later in the show. So we're not done with Roths just yet. But let's take a sidestep from Roths for our second to last point. And again, filling up your stocking stuffer with great financial freedom type advice today. And this one's a pretty easy one. It's kind of like that debt one. It's sort of a duh sort of thing, David, but kind of sometimes we need that reminder, and that's to revisit your plan at least annually.
Yeah, and so this gets kind of confusing for people. I'm going to say something, and then I'm going to backtrack on it.
Okay.
But the answer usually is if you don't have a written plan, then you don't have a plan. And so my experience over the years is that financial freedom comes from having a high confidence plan. If you can see how your money is going to roll over the next 10, 20, and 30 years, and you have a very high level of confidence that when you get to 95 or 100, you're going to have at least as much as you need to close out your life, or at least as much as you have as a goal for leaving for your heirs, that's a high confidence plan. You know, your investments might do a little worse or a little better than expected. Inflation might be a little higher or a little less than expected. You built in a piece of your plan for long-term care. That may cost a little more or a little less than expected. But once you have those things in your plan and it's a written plan, then you're going to have a lot of confidence in the next 10, 20, and 30 years of your retirement. Now, a frequent listener of this podcast, a client of mine, said, you know, Dave, I don't think we have a written plan. And my answer to him was, well, technically that's true, but you are never going to spend through your money. So you already have a high level of confidence that running out of money is not your problem. What we're trying to do with you is to make sure that your end of life givings are in place, and that we have your risk allocation correct in your portfolio, such that each year you feel good about how much risk you're taking on and how much yield you're earning. So when I say that everybody needs a written plan, well, I have several clients that don't have a written plan because their stage of life and their amount of assets doesn't really require a written plan. If you're unsure about how many assets you're going to have in your 90s, then you need a written plan. If you're at all concerned about running out of money, then you need a written plan. And it needs to be pretty detailed, something that you could go in with your advisor or with yourself and say, well, what if this happened? And then you make a change to the analysis and see what the answer is. Or, well, what if that happened? And then you go in, make that change, and see the answer. And that's where your high level of confidence comes from in retirement. Is you don't know for certain because stuff happens, but you just want a high level of confidence that whatever comes your way, you're going to be good, that the goals you've laid out are going to be accomplished. And so that's why I say annually, probably not more often, but annually, you need to make your calculation on your net worth, and you need to revisit your plan.
Excellent. We're back to that one last little bonus item here, David. I know it has to do with the Roths. You want to lay it on us?
I do. So this has a wide variety of application, but I can think of 3 different examples in my professional life here where this has been helpful to clients. So the stocking stuffer is, don't forget Roth contributions. So just a couple minutes ago, we talked about Roth conversions, what you already have in an IRA and you convert it to a Roth and you pay the tax. But for those who have earned income, let's say I have clients that have a gig job after retirement. They don't need the money, but they're kind of bored and they make a little bit of money. Let's say that you make 6 or 8 or 10 grand. You can put that entire amount of earned income into your Roth IRA. Why would you do that? Well, because if you put it into a brokerage account or a bank CD, the interest that you earn is going to be taxable. If you put it into a Roth, the interest, the dividends, the growth in the stock that you might buy is not taxable. And you can take it out anytime you want. There's a little wrinkle in that if you haven't owned the Roth for 5 years, but it's only a wrinkle. You can't take the earnings out, but you can always take what you put in out, even in that first 5-year period. A second thing would be if you have grandkids who have jobs, a real job, not, they would really need a kind of a W-2 job. So they're working at a actual business. And they're not even thinking about retirement. There's nothing that says that you can't open up a Roth in their name and fund it this year, next year, the year after. Maybe they're a college kid, they come home for summer, and their parents could do the same thing, and I have clients that do that. But we have clients that maybe make their kids maybe make 6 or 7 grand. Well, throw 6 or 7 grand into a Roth IRA when they're 17, 18, 19, or 20, and do it each year until they can afford to feather their own retirement nest. So you can do that for your grandkids. You can do it. You can do it for a friend of a family. And then the third is, if you have a young adult in your life and they're maybe already launched in their career, but you can also contribute for that person to a Roth IRA, even if they have a 401k at their job. I get a lot of weird looks from people, but that's true. There's a phase out as to how much they make. So if they are a single person and they make less than $146,000 this year, you can make a Roth contribution for them. Let's say, up to 7 grand. And they might be maxing out their 401k at work. It doesn't matter. As long as they make under 146 grand, you can do 7 grand in their Roth as well. If they happen to be married filing jointly, if their household income is less than $230,000, you can make that contribution for them. So there are opportunities to feather somebody else's nest with excess money that you have, and instead of just writing them a check, maybe you put it into a Roth for them and it grows tax-free, and they can, after the first 5 years, go get that money anytime they want, and it comes out tax-free. Maybe that's money they use for a down payment on a house. Maybe, who knows what it might be used for. Maybe they never touch it until they early retire at 60. And by that time, it could be quite a lump of money. So hopefully that is of interest to you as you think through your life, and maybe some of the younger people in it that could use a little boost from you.
Great points across the board today, David. There you have it. Several stocking stuffers to help you achieve financial freedom in 2025 and beyond. A great way to end the year there. Again, if you've got questions for David, want to meet for a review of your planning process, you can go through that complete planning review and see if you are ready for retirement, what tweaks need to be made, how you can make sure that you are pointed in the right direction for the years ahead. It's a great way to do it is to pick up the phone, schedule that time to visit. 913-317-1414 is the number, and we're also online at coveryourassetskc.com. Coveryourassetskc.com, and that's another great place to get more information, resources, and contact the team that way as well. Contact info all in the description of today's show in case you need to find it there. And David, thank you so much for your help today, and hope you have a great rest of the year, and we'll see you in 2025.
Well, thank you, Walter. To our listeners, if you celebrate Christmas, if you do it with family, just hope it's a fantastic celebratory time. If you celebrate Hanukkah, I'm pretty sure that starts on the 25th of December this year. So hope it's a fantastic family time for you for that. However it is that you celebrate this season, we just hope it's a real blessed time for you and your family, and we'll look forward to doing some hopefully interesting stuff in 2025 on this podcast. So happy holidays and Happy New Year.
Thanks so much, David. Well said. And we'll see everybody in 2025. Come back and join us. For David, I'm Walter. We'll see you again on Cover Your Assets, KC. Advisory services offered through Creative One Wealth, LLC, an investment advisor. KC Financial Advisors and Creative One Wealth, LLC are not affiliated. We are an independent financial services firm helping individuals create retirement strategies using a variety of insurance products to custom suit their needs and objectives. The information and opinions contained in this program have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. They are given for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. This material has been provided by a licensed insurance professional for informational and educational purposes only and is not endorsed or affiliated with the Social Security Administration or any government agency. It is not intended to provide and should not be relied upon for accounting, legal, tax, or investment advice.